So I recently filmed a video where I did a Shark Tank React on this company called Doughp, which what they do is they make cookie dough by the scoop. And so they just sell cookie dough. I think you can actually cook the cookie dough and make cookies, or you can just eat it straight out of the carton like you would ice cream. They started by having these like ice cream parlors, but there were more like cookie dough parlors where you could get scoops of cookie dough in a cup or in a cone. But now today they sell mostly direct and through retail locations. Well, they're also just wrapping up a fundraising campaign on WeFunder. And so I thought this would be a fun one to do the Shark Tank React and see how the sharks responded to it and what they thought was important to ask about, and where the company is today, because that Shark Tank episode was shot in 2019. And so curious to see where they're at today and whether or not, it's a company that's worth investing in. Just a reminder, none of this should be construed as investment advice. I'm not promoting Doughp or saying that you should invest in their company. I just think it's an interesting one to look through, and hopefully it's useful from an educational and entertainment purposes only. All right, let's take a look at Doughp and see where they're at. Okay, so looks like they're closing their campaign here in 6 days. So far, they've raised about half of their funding goal, $336,000, which is great. That's pretty close to what they originally pitched on Kickstarter. Let's hit their highlights real quick. So $13 million in lifetime revenue, $3.9 million in 2022. So like that feels like a bit of a disconnect that maybe they're not growing super fast and they've been around for a long time. I would be hoping to see that like 2022 revenue would be closer to about half of lifetime revenue. But so be it. It's still great to have generated $13 million in lifetime revenue. Sold in 1,000 doors within first year of retail launch. So they're in Costco, Walmart, Target, Kroger. That's great. And 1,000 doors is really just a drop in the bucket of what these different companies have in terms of total doors. So hopefully there's some land and some expand opportunity there. They've been on Shark Tank a couple times. Ranked number 16 in the Inc. 5,000 fastest growing for food and beverage. That's cool. Although like not super meaningful because lots of companies can kind of game some of their numbers there. First company to ever successfully repay its WeFunder investors. That's interesting. So they did a rev share raise where they must have raised money and then shared the revenue to pay back that money. So it was kind of what's called revenue-based financing. That's kind of cool. Passionate founder. I heard her story on Shark Tank and she did a great job. She started working at Intel at the age of 16, which is like super impressive. And worked in tech for a long time. And then, she had an alcohol problem, but overcame that and is sober. Like, I just really love like a lot of that passion in that story. Says a lot about like the drive of that type of entrepreneur that I really like. Donated more than $100K to mental health and addiction recovery nonprofits. That's awesome. I love kind of the mission there. And then Barbara Cochran, I don't think I've met a more sophisticated owner in my life. That's great. That's such a great quote. All right, let's see. So it looks like it's either her and her brother or her and her husband. Civil engineer turned entrepreneur. 0 to 3.9 million in revenue in 2 years. See, this is where there's a disconnect. In 2 years, they got to 3.9, but they've done 13 million in lifetime revenue. Something's not adding up there. Okay, so let me just say this about like, assuming that they are related, since they both have the same last name, I'm going to assume, and maybe this is a bad assumption, but I'm going to assume that they're married. This is usually like a huge red flag for VCs. And there are a lot of VCs, and for a long time, VCs were like, I don't invest in a husband-wife teams. Because there's this risk. It's like a known risk. And like, why would you invest in a company when there is like this known risk that's so obvious that like, what happens if they get divorced? Does that just implode the whole company? The flip side to that, though, is the argument that like, if they're both on the same team and they're both like pushing super hard together, then yeah, there's some risk that they will get divorced. But the flip side is they're going to be like a power team that are super close, cranking as one to make this thing super successful. And you actually saw that, like, probably the best case study of that is the company Cisco, which was started by a husband and wife team. So it's totally possible, but it is definitely a red flag and like a concern or a risk that you need to be aware of. I just want to look at their lead investor really quick. So the lead investor invested $30,000. Sherry Garcia. Don't know anything about Sherry Garcia. Founder of staffing agency for second chances. All right, she looks like a cool person, but an entrepreneur, but not like a well-known investor. So I don't know. It's not really a positive or a negative in my opinion. It would be a stronger positive if they had somebody that was a more credible investor in there. 6 years in business. There she is with her badges at Intel at age 16. I love how she's got a lot of stuff about her and her story and starting the company and so forth. So so I know down here, she's got information. Let's see. Launched at Target, expanded our store count by 20% at the next review. That's cool. So like it's doing well in retail. It's always like a really strong sign. Target reordered another three full truckloads of product. That's cool. They're going to hit a whole bunch more locations in Texas. So it sounds like they're having some really early successes here in the retail environment. What I'd like to do is, a bunch of reviews, that's great. I want to look at this deck of theirs and maybe just quickly go through it. So we've got timeline starting in 07. No, she started her career in 07 at the age of 16. She started the company here kind of in 2016, 2017. 2017 is really where she quit her job and started Doughp. Okay, so from 2017 to 2023, she's gone from 0 to 3.9 in 2022. So, that's like 5 years. It's not bad given that she probably hasn't raised very much money. Not to say that like values aren't important, but I'm just trying to skip through to some of the things that I think are important. So leading dessert brand, favorable tailwinds, largest and fastest growing 8.6 in refrigerated and frozen desserts and novelties category, which is not only resilient, but grew during the prior recession. That's kind of cool data point. 8.6 is like a good size market, but not massive, especially when it's all desserts and novelties, which is a super crowded space. But no, nonetheless, it's kind of sufficiently big. Nationwide distribution, expansion plans, aspiring team. Okay, so people love cookie dough. All right, so here we've got the market landscape. Here we go. Remember when I said like I was expecting lifetime revenue to be higher? Well, that's because I was hoping that they would be growing roughly 100% year over year. And because in the Shark Tank video that I did the react on, she talks about how they did 1.2 million in 19 and then ended up doing 2.7 in 2020. And so, over 100% year over year growth. And I was really hoping that she had been able to maintain that growth. But she only did 3.8 million the following year, which is, honestly not bad. But it does feel like she's kind of tapping out her market on the D2C side. And then here in 2022, revenue is basically flat year over year. And in fact, it looks like there was a pretty decent decline in direct-to-consumer. She says that's due to a significant reduction in online marketing spend to preserve cash for inventory ahead of their large retail rollout. Look, I think on the one hand, that's fine. My guess is that they also weren't getting the marketing efficiency because this is about the same time that there was a change in iOS 14. And marketing on platforms like Facebook just became wildly less efficient and more expensive. And so, they probably were struggling to get that same type of marketing efficiency. And so maybe they spent the same amount on marketing, but just weren't able to generate as much revenue. That is concerning, though, that like the product kind of doesn't stand on its own, if that makes sense. that people aren't like actively seeking it out and buying again and again and again. Which, to be fair, like this is an early stage business, and you'd expect that they still need to continue to build their brand. But from a direct to consumer standpoint, I would hope to see a lot more repeat revenue, and at least keep D2C flat if they were going to go and target retail and focus on retail. What they're doing strategy wise though is not like a huge surprise, because so many companies that were purely D2C are now trying to push more into retail as they're seeing their cost of marketing and customer acquisition go way up. And all of a sudden, those brick and mortar locations are looking more and more attractive because of their ability to acquire customers at a lower price point, despite the fact that they have higher operational expenses. I will say though, like one of the challenges that she's going to have, there are Harmons. That's near me. Maybe I should go get some for tonight. Let's see. This is how they compare themselves to everybody else. Interesting. Here's how they break up the team. So she handles pretty much all the marketing, and her husband or brother, whoever it is, handles basically all the operations. Yeah, that's good. It's good to see the split there. Man, this is a long deck. My tip, don't write decks that are quite this long. I mean, it's fine, but throw most of this in the appendix. I feel like there's a lot of fluff here. Okay, this is interesting. So they've got 58% direct-to-consumer gross margins. When they go to retail, that'll probably get cut in half. So then that'll push them closer to 30% gross margins would be my expectation. That's a ways off from their prior gross margins of almost 90% gross margins. So it's kind of disappointing that they weren't able to maintain as high gross margins, albeit not horribly surprising. You've got shipping, you've got packaging, you've got a whole bunch of additional costs that are going into it, whereas her 68-cent number that she mentioned on Shark Tank before for a $6 scoop probably didn't include all of the overhead appropriately. So there is that, which a lot of that overhead ultimately is going to get bundled into your cost structure on a COGS basis. So you would expect a lower gross margin for D2C. Lifetime value of 129. That's actually, not too bad when you consider that this product, it mostly probably sells at a sub $10 price point, which means your average customer is sticking around for quite a while and eating quite a bit. 129. So they have a subscription. I didn't see anything about subscriptions. So that gives me pause. I don't know how much weight to put into that, because I don't know how many of their customers are actually quote unquote subscribers. Subscription retention rate 65%. ROI on MSM. You know what? It feels like they're kind of picking and choosing different metrics to put here that make them look good, which is fair. Like that's what you do as an entrepreneur. But it doesn't give me enough data to actually make an informed decision here, in my opinion. 32% of repeat purchasers who buy again within 90 days. Okay. So 32%, so 1/3 will come back and buy within 90 days. That's pretty good. And then a 1.4% refund rate is also really strong. Scaled back ad spend to focus on retail. Okay, here we go. So here we're talking about how much they're spending on marketing spend, and they spent $1 million in 2022 and $2.2 million in 21. Wow. They spent $2.2 million on ad spend in 21 to only generate $3.9 million in revenue. That is a lot. That's a lot. And you can see what happened there is in 2019 they had no marketing expenses because they had pretty high expenses related to their physical locations. But then in 2020, COVID happens and they have to spend on marketing because nobody's coming to their retail locations, so they have to go all in on direct to consumer. But yeah, I mean, like, so they generate 2.7 on 1 million of marketing spend, and then you can see that marketing inefficiency just get whacked as it decreases from generating basically $2.70 for every dollar in marketing spend to closer to like $1.10 or something like that. And then they cut their marketing spend and maintained. I mean, they're down a little bit in terms of how much they sold on revenue. Let's look at that. So the 2.7 in direct to consumer on 1 million marketing spend. So to me, what that says is, one, iOS 14 was damaging, but two, they kind of they know where their low-hanging fruit is, where they're efficient on marketing, and they don't know where to go next to get good efficiency on marketing. And so it sounds like because of that, because they don't know, they're moving into retail to try and solve that problem. This is really good growth in terms of, what they're seeing. Although I don't know how much weight to put into these growth numbers in terms of number of doors at like Walmart, for example, in 2023. I wish there was some data in terms of like year to date where they're at. I've seen lots of forecasts over the years, and rarely do companies hit them. So I always kind of take that with a bit of a grain of salt. This is an interesting stat. I wish she had some of this. Like 68% of consumers cannot imagine living without a sweet treat once a day. That's kind of a sobering number. It's interesting. I probably fall in it too, though. Let's see. And then they have a bunch of data around how brands have performed during recessions. So cookies tend to do well, it looks like. So that's good. I love they're spending a lot of time answering that question proactively of hey, we're heading into a recession. Are people going to be willing to drop, $7 to $10 on this item? I think the one pushback I would have is that I feel like cookies and ice cream and so forth are a bit of a relatively affordable luxury. But I don't know that I would say Haagen-Dazs and Ben & Jerry's do well. I would be curious what that data says, how well they do during a recession. Here's their performance. I love that they put all their financials in here. I think that's great. I don't have a lot of time in today's video to really talk about these financials and go through them. But just some things that I would focus on is year-over-year revenue growth. They're looking to basically triple revenue this year. And I would love to see a lot more detail around how they get there. And just like I said, they're sitting at 57% gross margin for their D2C business. Their retail business is going to get hammered down to 36%. It wouldn't surprise me if it goes even lower, closer to 30%. I mean, we'll see, but... yeah, the other thing that we don't have here that would be helpful is more of the operational expenses in the business to better understand, is this company going to get to profitability? And if not, how much cash are they burning at the end of the day, so that you would have a better feel for whether or not your investment will give them enough runway to get to a meaningful enough milestone that they can raise money from investors. Anyways, lots of really good stuff in here. Definitely worth taking a look at this. In closing, I just want to spend a little bit of time talking about their valuation. So they're doing a safe, which if you haven't already, go watch my other video where I talk about safes and what they are and how they work. But basically, it's an agreement for future equity. So in the future, if you invest in this company, it comes with a $15 million valuation cap. So in the future, if an investor comes in and gives them money at a $30 million valuation, your investment will convert as though you had invested at a $15 million investment or valuation, thereby almost immediately doubling the paper value of your investment from 15 to 30. On the other hand, if they raise it like a $10 million valuation, you have a little bit of downside protection there because your investment will convert at that $10 million valuation instead of the 15. So there's some benefit there. Also with a SAFE, you're most likely to get paid out before any of the equity holders. So you have a little bit of downside protection there. Although it wouldn't surprise me if they have a decent amount of debts. So you would get paid back after those debts, credit card debt, bank debt, etc. $15 million valuation. So at a $15 million valuation, you're looking at being pretty close to that 4x valuation that she was pitching on Shark Tank. Honestly, I have mixed feelings about that. If I felt like if I could see more visibility into year-to-date revenue and felt more confidence that they were actually going to get to that $11 million top end number, that could maybe like get me interested at investing at that valuation. But given the fact that they were flat at 3.9 for the last 2 years, really gives me pause on whether or not I believe their story that this year they can magically triple revenue just by moving into retail. And then you also have to take into consideration that margins are getting hit hard by moving into retail. And on top of that, we don't really have any data around how much cash they're burning and how much runway this would buy them. So anyways, those are all like some of my thoughts. What do you think down in the comments below? Have any of you tried Doughp? Is it good? Is it worth eating? Love to know. I think I might go try some. What do you think about this investment? Regardless of whether or not it tastes good, is it a good investment? What do you think? Thanks for joining. If you haven't already, go back and watch my video where I do a Shark Tank react to Doughp and hear what the sharks had to say about this company. Thanks.